time frame is not important. To me, in fact, to me, the answer to that is the least important time frame to me would be like a weekly chart. If you're a spot trader, what's the point of looking at data from 4 years ago? Do you think the market conditions and market sentiment are still 4 years ago? Hey, the dollar might have been strong 4 years ago because everyone was trying to buy the dollar for safe haven. Now everyone's trying to buy the dollar because it's the only stock market going up. And it's the only major raising interest rates. Hey, the dollar's strong, but not because of your weekly chart. In fact, it's the exact opposite of your weekly chart. So be careful of the confirmation bias, right? Perception creates reality. Man, I was having a conversation the other day and I couldn't remember that. I said it was a Nietzsche quote. Does anybody know if that's true? Is that Friedrich Nietzsche? Perception creates reality, which is another way of saying confirmation bias. Does that sound right? I know. What kind of a-hole has conversations about Friedrich Nietzsche? Yeah, wow. Welcome to my world. Welcome to my world. All right, so I guess we should get going. Bada bing boom, huh? Hey, good morning. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. A lovely little spot in the world where you can trade Forex, energies, metals, indices, binary options, and we host these strategy sessions every single day, 7:30 in the morning, which is a couple hours before the equity market opens in New York City. It's also a London lunch. Fabulous time to realign the satellites and look at our daily trading strategies. And on Friday, we do it at fxstreet.com, the most powerful Forex website on the planet, fxstreet.com. So pretty cool stuff. La, 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 la. Let's get going. Got lots to do today, fundies and technicals. Trading is risky, not appropriate for everyone. Your past performance, good or bad, is not indicative of future results. Never risk money you cannot afford to lose. Everybody stare at that logo. Say, hello, TradersWay. I'm going to sip on my coffee. Thank you, minions. Good coffee day. You may live a little longer. All right. So here we are. Forex.today, and time to look at our calendar. Anything interesting going on? CPI and FOMC. These are two huge points of contention today, otherwise known as events. You can have event-driven strategies based on this information. Cool. So, have you been hearing on the streets or in the articles that you've been reading, maybe at Bloomberg or CNBC or the Wall Street Journal or the Financial Times or Investor Business Daily, maybe The Economist? Have you been reading that investors are focused on CPI today more than most times? Like this is like some unbelievably super important CPI? Yeah. Figured. And why? What has the world been telling you? Because I haven't actually been to any of those websites. But I could read your mind, huh? Because it'll signify the rate change. Yeah, classic, right? So here's what you're probably reading. This is so important that the Fed is going to be like hunched over the radio, because they're old, waiting for the CPI data to come out. And they're going to make a decision based on today's CPI, whether it should be September or December. How dumb is that? Really? They're all waiting for the CPI data? Like, oh my gosh, this could change everything. Do you honestly think That's how the central bank of the reserve currency of the world does it. We haven't made a decision. We don't know what we want to do, but you know what? If CPI comes out hot, that'll change everything at the Fed. Really? Really? I'll tell you, I think you're hearing that so that you spend more time watching the financial TV programs and watching really commercials, or buying newspapers or subscribing to magazines. I mean, you're like, wow, we got to watch this. It's so important. It's the biggest CPI ever. Yeah. All right, cool. First of all, the Fed doesn't even really use CPI. That's one of the biggest problems with that, hypotheses. Now, sure, okay, CPI will probably move the market because I think a lot of people will think it's important, but it won't really actually be important. But, it'll be event, and maybe because it is hyped up from TV, it'll move a little more than normal. Cool, whatever. But in reality, it's completely false. The Fed doesn't pay that much attention to CPI. They just don't. The CPI, just another form of measuring inflation and stuff. So anyways, CPI, it's important. Well, it's always important. And we want to see a good number versus a bad number, not because we want to like force the Fed to do something, but we're on a path for economic improvement, right? But it's not going to do a damn thing at the Fed. Unless it comes out 10 times better than expected. Holy snap. But what's a probabilities of that? Let's pretend you're a financial analyst now and you've been studying 50 years of CPI data. And you're going to have to come up with an economic model of what you think today's CPI is going to be. And you got your like low probability, average probability, high probability. Now your high probability, what's the highest high you think is reasonable? 0.5, right? So, what do you think it's going to be? 2.0? I mean, just like even if you went crazy, you couldn't come up with a giant number. Now we know at the beginning of this year and in the beginning of last year, we had slow economic periods, right? So we're slowly dropping some of the smaller numbers. So yeah, it will go up, and it might go up more than expected, right on. And the markets might actually move more than usual for this kind of data because it's been hyped up. Cool, right on. Let's make some pips. But I just want to make sure, like fundamentally, it's not going to change anything. It's not going to like say, oh, now it has to be September. No, come on. Seriously, no. I mean, no. 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 I want you to be smart money. I just want you to I mean, you should have already done your analysis. You should already have an idea. You should already have a strategy for the US dollar, so on and so forth. So anyways, don't be fooled, right? You're smarter than that. So cool. And then if you're like, Wayne, well, what's PCE? Well, Google it, dude. I can't. I don't have the time for that. All right. Right? Cool. All right. So anyway, CPI will come on. It'll be important. Let's trade it. Somebody asked, is core better than headline? Well, core just removes energy, so and some I think some food, right? But whatever. But CPI includes things like a dentist bill. I mean, it's a really interesting, so on and so forth. Okay, and then meeting minutes are released. I asked everybody to read the RBA meeting minutes. I'm going to ask you to read the FOMC meeting minutes. Yes, Nick. Is anyone willing to actually download and read the FOMC meeting minutes? Okay, cool. I think it's important. I don't think you're going to get some sort of like secret sauce recipe out of it, but you are trying to become a successful and potentially professional currency trader. Am I right? Trade your money profitably, maybe trade other people's money profitably, maybe work at a bank or a hedge fund. And in any situations, is reading the Fed's meeting minutes going to hurt you? They're like, oh, really? Well, we don't know. We don't like people like that at our firm. So, read it. And I would highlight things that stand out in the conversation and maybe you don't quite get it, and then start doing research. See, that's what I would do. WWD, what would Wayne do? I'm like, what is this? They're talking about PCE. They're not even talking about CPI. Well, what the heck is PCE? And there, off you go. So why do I know PCE versus CPI? Ching, because I read the meeting minutes. I don't read the Wall Street Journal. I stopped reading the Wall Street Journal. I listened to a Ben Bernanke Senate testimony. I watched it live. It was hours and hours and hours. Well, not hours and hours and hours. It was, an hour and a half of testimony. Terribly, terribly, terribly boring. And mostly because the senators and when the Congress is doing it, it's even worse. But they're asking really dumb questions, and there was lots of grandstanding and all that. But anyways, I'm there, I'm watching it, and I get it word for word live. I hear it from the man's mouth. And then the next day, I'm reading the Wall Street Journal, and they report it the exact opposite. The exact opposite. You couldn't have been more wrong. And I'm like, holy crap. The Wall Street reporter wasn't even there, didn't even watch the testimony, and they printed this nonsense. And they're completely reporting it. So, wow. Just, what the scariest part of it, though? You know what the really scary part of it is? The market moved as if the Wall Street Journal was right. And I realized right then and there, many of these billionaire hedge fund managers that pay themselves $1 million a month, the ones that you dream of being one day, lots of them are idiots. And you're much smarter than they are, and your value is much higher than theirs. And the only difference between you and them is the amount of money. So let's get you on top. The world needs your success. They need a leader like yourself. The world wants a success story, and that should be you. And core CPI will come out. It'll be interesting. It'll be higher than last. The market's going to go yeah, and then but here's my thought. I told you, I don't know. months and months and months ahead that the third week of August is going to be the turning point, and that the mission is going to probably start to continue in the direction of the prevailing trend. And so we have moves like this that we've been trading since the beginning of the year, for example. And I'm just wondering if some of these trends are waking up, and this is the beginning of the beginning. Okay? This could be the beginning of the beginning of the end of the summer. And so you get things like, Euro USD has been going up for what, a month? Let's look at it this way. That's kind of ugly. Okay, since the beginning of August, Euro USD has been going up, right? Can we generalize that? Okay. What happened in the beginning of August to create this move for the entire month? This thing starts going up. The European pig dogs take the entire month off of August. We know this. We talk about it every year. I was once in Zurich, one of the largest financial centers in the world. I was in Zurich one time in August, and the entire city was closed. I mean, entire buildings had their lights off. Not just like a few people go on vacation. Everybody. Guess what? Next year, it's going to be exactly the same as this year. Just take it down. Okay? So here's what, sort of the human nature of the market kind of takes over at times like this. That people have been shorting the euro, decide, it's time to go on vacation. I think I'm going to take some trades out of the market and go away for a while. But they're short euro, they're not long euro. So when they get out of the market, guess what? The shorts are offset by longs because that's how you get out of the market, and it goes up for a while. When should the overall mission continue? When should the dollar start gaining strength, or maybe let's just say euro getting weak again? When should euro weaken again? Well, when some of these traders come back from vacation and start shorting euro again. Because they're like, all right, well, ECB is still going to print money till 2017. Why do I know that? Why can I just say that? The ECB is going to continue printing euros until 2017. Well, because they told us. Now you're going to read, if you watch maybe again, let me pick on the TV pro, CNBC. Oh, they're going to debate. They're going to debate this. Well, what do you mean debate it? It's already a fact. Well, let's have a big conversation about it. All right, well, fine, whatever. So long story short, we're kind of in that third week of August period, and we print a double top, potentially a lower high scenario. And what if this is the beginning of the end of the euro? What if we're on our way to 80? How long are you going to stare at this before you realize it's happened? How hot does the water need to get before you realize that you're in the pot on the stove? So this is sort of like wake-up call, right? So what's your alpha? What are you going to do to make money? What's your plan? What's strategy? Okay. Now, clearly, there's still some supportive areas in here, right? So, we know a bull is thinking this. We know that. It's not complicated. So the only question is whether the bears are going to show up to the party, or if they've already showed up party, right? That doesn't look good. Hang on. Thought I grabbed magenta. So what would a bear do, right? And probably a bit of a chin. And then, so on and so forth. You should start planning the next few months. No joke, guys. You should, like an analyst that comes up with probability A, B, and C, ask yourself, between now and the end of the year, where is the euro going to be? Parity? $80? $125? Where do you honestly think it's going to go? I think it's a valid question, isn't it? I have $100,000 I can give you to trade. Right? I've set aside a couple of $1,000,000 to give young traders. Sort of like an incubator for currency traders. And so what if a basic question, if I interviewed you for this position, and I said, okay, well, give me your outlook till the end of the year on euro. I can't do that. All right, goodbye. Smell you later. Convince me you know. And then the next question is, how's it going to get there? What? Yeah, open up a chart and show me how we're going to go. Well, how would I know that, Wayne? Well, it should be obvious, right? Let me clear some of this up. The obvious part is that it starts with support and resistance. When you're at support, who buys? Tico, the funny thing about that is, don't we say every single day past performance doesn't predict future results? And then the regulators say, oh, but you have to give an investor 5 years of trade data. And then tell them that that data is not indicative of future results. And then ask the regulator, doesn't that contradict itself? And then realize that you're calling the warden of the prison an idiot. How does your life turn out? Yeah, God forbid you stand up for yourself, right? Yeah. So anyways, yeah, you should be able to do a couple of things. You should be able to identify support and resistance. And if you're a bear, you should still know where the bulls want to buy. Like, for example, is that support? Would you consider that support in the future? Yeah, okay. Do you think a bull is going to buy there? Well, look, you just predicted the future. It's not hard, is it? Are we at the top of the range now, potentially? Okay. If we're range trading, granted this is a big range, a daily chart, which tool do we use to measure overbought, oversold conditions in a range-bound market? Stochastics. Does Stochastics approve the trade plan of this heading down to the bottom of the range? Yes or no? Yeah, it's certainly not saying no. Okay. What about things like a 5A cross? Is price action pointing down or up? Huh. All right, cool. And then once we continue this, by the way, you're the one predicting the future. Cool. Is it going to go straight down? If it goes down, is it going to go straight down? Okay. So it's going to have to make lower lows and then lower highs. Huh. Well, that's pretty interesting, isn't it? So it'll head down, hit support, rally up a little bit, and then bears are going to take it down to the new support, to the next support line. So is this a support level? Okay. So let me change colors here. So it's not going to go straight down. So generally speaking, let's say it can go like this. Okay. And then when it breaks finally, what is it going to do? Okay, it's going to come up here. And then it's going to go down here. Generally speaking. Now that's a daily chart. So these little pullbacks can be like a week and a half, right? 2 weeks, maybe 3 weeks. Who knows? Depending on the slope and velocity of things, right? And of course, we don't know when the Fed's going to raise interest rates. Maybe it is September. Well, we'll just get down there more quickly, right? If it's September, it might be down, up, down kind of thing. But whatever, right? So you just have to change your strategy and say, well, so you could say, all right, I'm a bear. You have to make that decision. Okay. Would the market be more bearish for the Euro USD if the Fed raises interest rates in September? Would it be more or less bearish? Okay. So you have two probabilities now. One, SEP. Two, Ds. So now you can plan this based on you believe the Fed, or just who even cares if you believe or not believe. If the Fed raises in September, plan it now. What will it look like? Oops. Okay. And if it's December, what will that look like? Would that be fair as a bear? Okay. And let's say we break the zone here. We break this low at 105. Where is it going to bounce? Predict the future. Where's the next support? Parity. Why? Because it's a psychological level. Okay. And more likely than not, I'm going to guess here, which is called a hypothesis, that if it does go down to parity, I don't even know if I can squeeze this in here. There it is. If it goes down to parity, I think the market's going to overreact. So there's parity. So we get down there, and I think it's probably going to have a bigger pullback like. Okay. It could go further, but I wouldn't be shocked if the world makes too big of a stink about parity, about 1.0. Now, if you take away the psychological level, between now, let's say 2015, so we're in the second half now, to 2018. I'm going to predict that the Fed will be in a policy of tightening money supply. And by, I guess this arrow means interest rates, I guess. And the ECB will be in a policy of expanding money supply, which is kind of funny. So I said expanding. Okay, well, whatever. So basically, the value of the euro should go down in this period, and the value of Fed, or the policies of Fed, which is the exact opposite of these, would most likely increase the value of the US dollar. Okay? That's right, James. Now, actually, James, I said December of 2015, or even, I think I might have even been saying the first quarter of 2016, but like a year and a half ago. So I'm not even thinking about last month. I mean, literally, we talked about this a year and a half ago. But cool. So we call this, now we're talking about fundamentals, right? That these are diverging central bank policies. And I think if you put them together over the period of time, I don't see any reason why it couldn't go down to 80. I mean, this isn't like one-off blips of news, is it? These are long-term diverging policies. The euro should, not just could, but should lose value all the way to at least 2018. Or ish, right? Maybe fourth quarter 2017. But years and years and years. Okay? The ECB actually wants it. It's the whole point. Okay? Which is good if you're an American because Mercedes are going to get cheaper. But the funny joke about that is actually Mercedes produces more cars in the United States than they produce in Germany. And Germany now is importing their Mercedes SUVs from the United States. Germans are driving around in American Mercedes. And I believe Mercedes is moving their South Carolina hub here to Atlanta. So people in Atlanta are going to drive Kias and Mercedes. How funny is that? But actually makes a lot of sense. So, yeah. So, these are trends that, like trade winds, right? I think you can open up your sale and generally know what direction you're going to go. Okay, so that's the plan. That's what I'm thinking about. Okay. Well, pal, if you were hanging with me over the last year and a half, you shorted the Euro USD at the exact top. We were actually 3 months early because Draghi was actually 3 months late, but and we sold it. I used to sing this song all the time. You wake up in the morning, it's 1:45. What do? You short the euro. You short the euro. I mean, we just joked about it. It was so unbelievably easy. And we had that ball teed up well before it happened. We discussed it every day, and then finally the ECB acted, and that was that. We had diverging central banking policy because at that time, the Fed, I don't know what, 4 or 5 months earlier, started the taper, and I was already dollar bullish. So the next part is we just needed the ECB to act so that the euro could weaken. And they needed it. They were desperate. One of the biggest contributors to the European deflation, think of it, this was their problem, deflation. One of the biggest contributors to European deflation was the overvalued euro. Because if the euro could buy a lot of stuff, you didn't need much euro to buy anything. That's deflation. Inflation is you need lots of euros to buy stuff because everything's expensive. Not everything's cheap. So, but here's the problem. Draghi didn't have the mandate. So he had to go to the courts. So we would track all this. He's in the courts, begging the legal system, begging the Germans for permission. And then finally, it took 3 weeks for that to happen. Finally, yes, it's legal and all that kind of stuff. And finally, he did it. And they didn't call it quantitative easing, but it's quantitative easing. Anyway, so it was again pretty straightforward. And down every single day. Down. Okay, fine. The velocity was really fast, right? The velocity was quite fast. Probably too much. People overshot because the Wall Street Journal and CNBC had everyone convinced the Fed was going to raise interest rates. Remember that? In like February, and if it's not February, it's April. If it's not April, it's June. I mean, oh, you serious? And then if you just listened to Janet Yellen, if you just read the meeting minutes, there was no way in hell they were going to raise interest rates in February or June. It was stupid. But that anticipation created a very, very strong dollar, more than it should have been. And all of a sudden we're down here at 105 and there was no reason for it. Whoop. That's why we came, quite a ways back. But now here we are at more like reasonable, sensible prices. Everyone's taking their vacation. We've had our cooling off period, and now we're thinking with our brains again. And the market's coming back. Do you think when the market comes back, they're going to buy euro for the next 3 months, all the way to the end of the year, let's say, whatever that is? I kind of always think it's for like quarter, but 4 months. Do you think the market's going to come back and drive up the value of the euro for the next 4 months? Okay, so I'm going through this because I know I prepared people for weeks and weeks and months for some of these moves to happen. We talk about 2,000 pip moves. I'm sorry, it moved 3,000 pips. And like the frog in the pot of water, people stare at it and they think nothing's happening. And then 6 months goes by and they're like, oh my God, it did move 2,000 pips. So I'm just trying to say, you're in the water the pot is on the stove, right? And the heat was just turned on. As a frog now, should you change your behavior? No, Jimmy, purely Euro story. Absolutely not. The Euro story, there actually is no Euro story. We already know what the ECB policy is all the way to 2017, maybe 2018. They're expanding the money supply, devaluing their euro. It's going to take 5 years to see any results. Okay. So right now the story is the velocity of interest rate normalization is what you would talk about at the Fed. Okay, the rate of normalization, because interest rates shouldn't be near zero, right? In the United States, it just shouldn't be zero. So they just got to get it to at least normal levels. How fast are they going to do it? We don't know. These are the more important questions. Right? Let me give you an example. Do you guys want to go to school? Quick school lesson here. And then we'll catch the all-important CPI data. All right. Let's have some fun. All right. You're an investor, and you go to the Treasury today and you buy a 10-year T-note. Okay? Face value is $1,000. Okay? The yield right now, 2.2%. Okay? So there you go. You know that you are going to earn 2.2% a year. So you receive 2 payments. Every 6 months, you're going to receive a payment of 1.1% every 6 months, right? So you're collecting 2.2% a year. And at the end of 10 years, the U.S. Treasury is going to give you your $1,000 back. Cool. Risk-free. Correct? Cool. All right. Then next year, so like starting in December and through 2016, the Fed raises interest rates just a little bit. But now, so 1 year goes by, so year 1, year 2 goes by, and now 10-year T-notes, comparable 10-year T-notes issued in 2016, now pay 3%. How does this affect you? You're guaranteed your 2.2%. You're going to get that. And in 10 years, you'll get your $1,000 back. So you're guaranteed that. But let's say you change your mind, because actually most investors do not hold the bond until maturity. That's why we have a secondary market. It's like, if an IPO comes out, do you buy the stock and hold it forever? No, I mean, it only worth something when you cash out, right? Well, you can hold bonds to maturity, or you can get out. So you say to yourself, wow, maybe I made a mistake. I want to sell my bond. Well, if the exact same bond is currently paying 3%, do you think you could go out and sell your $1,000 bond for $1,000? So how do you convince somebody to buy it? What do? You have to reduce the price. So you've actually incurred a capital loss if you market to market. That's why mark to market's important. So now your bond might only be worth, 983. There's a way to calculate this, and then you also have to adjust for time value of money, and we don't need to get into bond pricing. But I'm just saying, your bond falls. See, the bond market is about to crash. You know that, right? It's the end of the world as you know it. It's the end of the world as we know it. So I thought it was risk-free, yo. But how could it be risk-free if you just incurred a capital loss? Good question, Wayne. So risk-free, yeah, but another way of looking at it is you are losing money then based on in real terms. So your nominal return is 2.2%, but the value of your money is changing. Okay. Also, when you normalize, when you look at real returns, compared to what? Right? So let's say inflation's 2% a year, but you're being paid at 2.2%. Okay, let's do a real easy calculation. So what's your return on investment now? 0.2% a year. Okay. Could you possibly get a better rate somewhere else for this, for a reasonable amount of risk? I mean, you basically break even on the sucker now, right? And also, there's a thing, there's a thing in finance that says time has value. Okay, if you lent me $1,000 and I said I'll pay you back tomorrow, there's an extreme likelihood that you would get your money. Okay? I'll borrow, I just need it for a day, but I'll give it back to you tomorrow. And I'm good for it. You know it. Not a problem. And so you're like, yeah, go ahead, buddy. Not a problem. I'll trust you. Okay, fine. But what if you had to lend me $1,000 for 5 years? Maybe that's not a good example because it's not enough money. All right, what if you lent me $10,000? And I say, all right, I'll pay you back in 5 years. Well, now this creates a problem, right? Well, what if I screw you over? So now that's risk. Risk also has a value. Risk needs to be compensated. So now you're going to charge me an interest rate, right? I mean, it's right. I mean, 5 years. So you're like, all right, well, I'm going to have to charge you a little bit because you might default. But what's the other, right? Well, that would be the insurance, Warren, basically, right? But here's the other issue. What could you have done with the $10,000 besides give it to me? Right? There's an opportunity cost, right? What if you had it in the stock market and the stock market goes up 40% in that time period or even doubles in that time period? See what I mean? So now you got to adjust for that. So anyways, long story short, your bond was a terrible purchase. Risk-free. But you'll nominally risk free, but in real terms, it wasn't a good investment. So now let's put this in now perspective, and then we'll get ready for CPI here. If the bond market's going to crash, what should the stock market do? What's inversely correlated to bonds? Okay? Wow, you just predicted the future. I like you. You're crazy. Now, I don't think it's going to be overly dramatic, and I sort of have a obscure focus on this one. The reason ridiculous inflation right now is the Fed is actually controlling it. The Fed could do one thing right now today and create hyperinflation. They could snap their fingers and without printing a dime or a dollar. So they're controlling the rate at which this inflation comes back. So they're going to do it very, very slowly. Exactly, Simone. If they stop that, it would be over. The dollar would actually weaken, not strengthen. I don't think I said, is it Simon? Is it Simon or Simone? I guess, is the A silent? I don't know. Simone. Yeah. How about Russell? All right, so let's get going. This unbelievably important CPI. It's the most important CPI ever. It's coming out in a few seconds. Brought to you by TradeTheNews.com.
July CPI data in the U.S. in just a few seconds.
Simone.
CPI 0.1% is 1/10 lower than expected. Core at 0.1%, also 1/10.
Oh no! The Fed's not going to raise interest rates in September.
Earnings at 2.2% for July versus 1.8% in June.
.1 versus 0.2. OMG, that changes everything. Now the Fed can't possibly raise interest rates in September. Let's get all the talking heads together and discuss what does this all mean, Basil? Oh, is it December? Oh, it's going to December. How many idiots have you seen on TV that said, absolutely, definitely going to be September? Now they're like, oh no, it's not. It's blah, 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 blah. All right, cool. So, wow. And at the end of the day, nothing just happened. Yay. Cool. It's the end of the world as we know it. It's the end of the world as we know it, and I feel blind. Guess we'll monkey it around like that. What do you think? Well, Michael, let's talk about that for a second. Let's let this process cool off here, and then we'll go talk about it. You know what I do want to talk about while I'm looking? So I'm looking at other things, obviously, guys. But one thing that's on my mind, um, when China devalued, right? We got together on a Monday, and everyone's like, "What does it all mean? China devalued. What does it mean, Wayne? What does it mean?" And we talked about it for about a half an hour, right? I'm like, "Let me tell you what it means." And in fact, we had even talked about it before it happened. Maybe not in that type of way, but we knew they were going to do something. That they tried the RRR several times. They already adjusted interest rates. I thought there'd be some sort of stimulus package, but devaluations is sort of the same thing, right? But what did I say a hedge fund would do to make money? Oh, nice trade on the Aussie dollar. Wow, that was awesome. Cool. If you're a hedge fund manager, no. When China devalued their currency, what do you do to make filthy, stinking, gross amounts of money? For your clients, of course. It's not collecting interest rate payments. Come on, guys, cause and effect. The sad thing is this is almost open book. We talked about it. What was it? What was it? Was it this Monday or last Monday? I guess last Monday. It's been 10 days. Is it still in the gray matter? All all Asian currencies that compete with China for manufacturing and exporting goods to the rest of the world will also devalue their currency. And I specifically said places um, um, like Thailand and Indonesia and Malaysia and Vietnam. Did I not say Vietnam multiple times? And South Korea. Yeah, Vietnam today, for the second time, has devalued their currency. Whoa! Say what? Oh my gosh! Awesome. So you must have had a $10 million short on that, right? That's just generally basic cause and effect. All right, here we are at the bottom of the range now, guys. See? Wow. Oh, the dollar's super weak. Oh no, it's super strong. Wow, huh? So anyways, just all I'm going back is sort of like, fact checking and grading and stuff. I want you to understand that there's a logical reason for why China is devaluing their currency, and we can talk about that intelligently. And then we can say, well, what is the effect of it? And we could talk about that. So Japan is going to have to continue with quantitative easing, maybe even increase quantitative easing. But, you shouldn't be long dong. You should be short bot, not long dong. Boy, that sounds funny, doesn't it? Yeah, the Vietnamese dong. Oh yeah, okay, so you guys want to talk about the Kiwi. Hang on. So of course I'd rather be short euro dollar than long. We've already established that. Nice moves, huh? Look at it, just gorgeous. You and no alone. So what did I say about the Kiwi? Did I say buy it? As someone I think said earlier. Remember, I'm a stickler for language. No. I said I would like to look to possibly corner the market on the Kiwi. That doesn't mean buy. It means identify levels of support, enter a long position, jam my stop, and walk away. There's a difference. You see what I mean? I need to be clear because there's a lot of amateur traders that would interpret that and just do the dumbest things I could possibly imagine, like buy it on the way down. Look, they're lowering interest rates. They're in accommodative policies right now. What we need is a market that is eager to capture the yield differential, even though it's not really a good currency at the moment. And one of the things I've been talking about is we need the average yuan in Europe to catch the cheap euro, or let's or let's say reap the benefits of quantitative easing and improvement in the job market and in wages and feeling good about the future. So he starts buying stuff, and that stuff just happens to be made in a factory in China, right? He wants to buy an iPhone. That's good for China and that's good for the United States, right? And when that starts to happen, China improves, and then when China improves, commodity currencies improve, and this is a 5-year process, right? So it's worth paying attention to, worth picking out zones, and seeing if you can take a let's say a moderate risk, high reward type trade. So if you're down at support, like we have been multiple times, you buy it and you keep a stop close, even though there's a lower here, you can wait for that. But if the market turns up, you jam it and you just kind of hold on, and maybe it starts doing this someday. Okay? Because this commodity currency is the one least exposed to China. So it's the least bad currency. So, when you say, I told you to buy it, whoa. Not necessarily. What I'm saying is currently it's the least bad commodity currency. But if you do against a yen, let's say, or a Swiss franc, some sort of decent funding currency, if the yen drops, this goes up. And if more people say, I need yield, perhaps they go to Kiwi because it's still paying 3%, right? It's still 3, isn't it? Which is a lot better than buying, a U.S. Treasury at 0.25. 0.025, right? 0.025. 3% sounds pretty good. Okay, so cornering is like, I will buy it at support, and if it goes up, I move my stop and I walk away. If let's say it goes up and then down and makes a higher high, you buy another one, jam the stop, go away. This one might get knocked out, and then it does this and goes back up, and you're still in the first one, and then it goes up here and then it comes back, and then it goes up again, and you buy another one, and now you're in here. So you're right. So now you got 3 positions open, and okay, and you're only in it for the yield. Yes, Greg. Greg, and so Greg's saying, well, the farther out you go, the more interesting it gets. Okay, but this in of itself looks stupid to buy. Okay, so I didn't say buy this. That would be stupid. But if you play it right with the right strategy, if you play it properly, let's say it's a low risk, high reward. If you keep buying and the jamming stops. Okay? Because and I want to be clear on the language, because if you interpret it as like, Wayne told me to buy this, a dum-dum, and I'm not saying you're dumb, but the guy next to you might be dumb. What they do is they buy and they buy and they buy. Like, oh my God, Wayne told me to buy it. I keep, and I've seen it. I've been doing coaching for a long time, and people will misinterpret what I say and then do the dumbest things on the planet. And it's because Wayne predicted it. Dude. And then, of course, let me point another thing out while we're on that topic. If you do anything in your trading because you said I told you so, because it's my idea, but like Wayne said this has to happen and Wayne said that has to happen, you might be a dum-dum too. You need to make your own decisions. I don't know what the future is. I'm not your financial advisor. I don't know your situation. Number one rule at the NFA is to know your customers. I don't know you. I'm not responsible for you. I might not even like you. I'm not responsible for your family and for your children. That's your problem. I'm just trying to teach you how to think. So you need to learn how to do your analysis, both technically and fundamentally. You need to learn how to enter your trades properly, buy at support, sell at resistance. I can guide you, but don't you ever come to me and say, well, Wayne, I just lost my family fortune buying the Kiwi because you told me to. I didn't tell you. Right? So we need to be careful, right? So a lot of people will sit here and try to interpret did he just tell me to buy it? What did he just say? Did he just tell me to sell the euro? I'm never going to tell you that. Because the minute I tell you that, you're going to stop learning. And if I'm going to make your decisions for you, I'm going to charge you a fee. You're getting a pretty sweet deal on the fee I'm charging now, which is 0. If you have, I don't know, at least $1 million, give me a call. We'll talk, huh? But other than that, make your own decisions. So I'm just trying to teach you the thought process that I go through to make my decisions. But do I know what's going to happen tomorrow? No, but I know what my behavior is likely to be tomorrow, right? You see what I mean? So look at this as more like a team process, and then ask yourself, when I ask you, if I say, are you a bull or a bear on this? You should actually think about it. Okay? So one of the many strategies you could possibly employ here is saying, well, as interest rates fall in most modern economies around the world, this currency just happens to look attractive relative to other ones, but the central bank is in a policy of, doing that. This was completely created by the Reserve Bank of New Zealand. And technically speaking, this looks like a dumb idea to buy. What I'm suggesting is a buy and hold strategy. If you buy at support, maybe even though this is a daily chart, you might be doing it on a 5-minute chart or a 15-minute chart. And if you get an opportunity like you had here, or here, you jam your stop or keep it close or whatever, and you just let it go. Okay? You might buy this 15 times and this one gets, this one gets knocked out, this one stays in. And you just keep doing it. And you're not risking anything, because if you're doing this trade properly, and one of the things I suggested is you go to TradersWay.com, put some money, like put $5,000 into an account, and all you do on that account is carry trade. And then you put 5,000 in another TradersWay account, and all you do day trade. Okay, one is a carry trade account, one is a day trade account, for example. Okay, and you treat them separately. So this one might simply, all you're doing is buying dips, moving your stop, and you never get out. And if you're doing it properly, your available margin should be 100%, because you are mark to market in real time, and you should probably have $2 million, $2.5 million worth of Kiwi funded Japanese yen on your little $5,000 account. But what happens is you buy the dip, it gets profitable, you put break even, 100% available, and goes up, you enter this one, it's for a while, comes back, knocks you out. Oh well, but the first one's still in, and then it comes up and you catch the second one, you jam the stop on there, then it comes in, almost knocks you out, goes up again, and after 6 or 7 months, you got 25 positions, all long Kiwi, and you have 100% available margin. That's what I mean by cornering the market. Now, of course, you're collecting interest payments, so your 5,000 will grow, but whatever, it just allows you to make more trades. Your stop's jammed on everything. And if you had 2.5 million in positions, open positions, and you're obviously all long, and the Kiwi moves up 100 pips, how many pips do you make? $100 times 25 standard contracts. So that's 2,500 pips, which for you is probably the best month of the year, right? And that's what you made in one day. Now let me ask you, what do you think hedge funds are doing? Do you think they're scalp 5-minute chart? Or do you think they're doing what I just showed you there? Keep in mind, generally speaking, every currency pair is different, but You have 2.5 in open positions. How much do you need to fund that? Now we're tiptoeing into it one at a time, and it takes you 6 months to do it. But let's say you just wanted to buy it. What is it, about $1,000 per contract? It varies for various currency pairs and stuff, but let's just boil it down. $1,000 to buy a $100,000 position. Okay? No, it's only 25,000. Okay. But you're collecting 3% yield. So what's 3% per year on 2.5 million? Anyone want to bust out a calculator? Right? 10% would be 250,000. 5% would be 125,000. Okay? But you've only invested $25,000. So in terms of your money invested, what was your effective yield? Do you see how you make $1 million a month as a fund manager? If you're doing stuff like that for your institutional clients? Now, clearly what you find out is you're making way too much money and you're ridiculously leveraged. So you start ratcheting down your risk. So you don't see it when you're scalping and spot trading and you got your little, retail Forex account. It seems all is good, but really at an institutional level, you have so much risk, it's ridiculous. But we need it because you're poor. But imagine now, if you can hold that for a year, you're going to earn 300% on your interest only. But what's the possibility the Kiwi yen 1,000 pips in 1 year? So every time it goes up 100 pips, you double your money, right? So it's only 1,300% a year. Yeah, but they're all at break even. You know what I mean? That's what I mean by cornering the market. You start to build positions. You know what we did last year in August? I spent the entire month of August building a position like we're talking about. I cornered the market on the yen. Short, of course. Spent the entire month. I begged people never to take profit on their yens. Can you imagine that? For probably 6 weeks, actually, that's all we talked about. For 6 weeks, every single day. That's the only thing we talked about. From middle of July all the way through the month of August. And the most critical week was the 3rd week of August, just like it is this year, right? Yeah. Hey, not a problem, Ron. But I'm just trying to bring it back. Everybody, here we are the 3rd week of August again. And, interested in these moves. Okay, the dollar is still strong relative to the euro, despite of our terrible, terrible miss on the CPI. Good thing I didn't freak out on that, huh? Yeah, we're just doing what we're doing. But what's interesting is if you back out and get rid of all this nonsense, and you have, let's say, a 6-month, a 12-month, and a 24-month plan, you don't get sidetracked by all this noise, right? So let's wrap up here. But why don't you plan out, since I think September, October, November, and December are the most important months of the year in Forex trading. Okay? Why don't you plan out, pick a currency pair you feel comfortable trading. Like when you look at a chart, it's like an old friend. Why don't you plan out these next 4 months? Plan out the next 100 days. Okay? Stop staring at your charts like it's a bunch of eye candy. It's not a video game. If you can be smarter than the average idiot, and we all know 95% of traders lose, right? So if you can just find out how to be smarter than them, which, right? Some people say, you know, 80% of success is just showing up, right? I say 80% of it is not being an idiot. So think about it, right? Let's plan this out. What would a smart investor do? Would they at least plan out the next 100 days? Ted says, how do you handle the 618? Oh, like the euro? It's a beautiful short. The one we had today was a beautiful short. Now, the CPI makes it tricky because it came all the way back, so you might have got knocked out on the 618. But if you were like a swing trader, not a day trader, you know, it was only scary for 5 minutes. Okay? So anyways, I want you guys to succeed. I don't know. Sometimes when I do these conversations, I sound pissy. It's because I'm frustrated. I'm desperate for you to succeed. So I'm not angry at you, and I'm not an a-hole. I'm not an arrogant prick. I want you to succeed, and I get frustrated when I feel like you're not waking up, right? I want to wake you up. You're stuck in the matrix. Wake up, Neo! Wake up! And we're at a critical point. This could be the beginning of the rest of the year, right? And I'm thinking the sleeping dragon is awakening, and we need to be prepared. I want you to be prepared. I want you to change your behavior. I want you to take this more seriously. So the Fed meeting minutes are interesting. It won't change your bias, most likely. I don't think it'll change anything. But the fact that you're the type of trader that reads the meeting minutes of all the major central banks around the world, that's the type of trader that I would like you to be. I think it would put you on a road to success. I don't think it's going to hurt you at all. But I think it would at least make you feel more confident, like you're a professional trader, for crying out loud. You're not some bubbling idiot retail trader. You're on a path to success. You are much more like a professional trader. You're thinking about the markets, you're reviewing central banking policy statements and meeting minutes, and you're planning your trades 3 and 4 months out in advance, and you buying and selling probably won't change at all. Well, George says, can you do that? Well, I actually did that earlier in today's session, so I don't know if you were late. but we actually kind of played around with the Euro USD. You know, what direction it's going to go, where it's going to bounce, and we came up with scenario A or 1, I think it was, and scenario 2. Okay? But the most important thing here is not whether you're right. The most important thing here is you're actually stopping to think, and that you have a long-term view, and that you're on a daily basis, because you've thought of this and you've analyzed the market, you have a strategy that you're working on a daily basis. Okay, like the Kiwi yen, like we were talking about. Okay, I want to buy dips. I want to jam my stop. Okay, I have a long-term view. Okay, and I'm prepared to take trades, jam my stop, and if I break out at break even, it's okay. Because to me, I want this to be a low risk. Like this is like a home run scenario, and there's a high probability of failure. So that's why I want to take it slow and tiptoe. I don't want to lose any money doing it, right? But it's because I have a longer term point of view, and I'm using fundamentals. There's no technical reason to do it yet. So, but it's something I might be willing to try. I might throw some trades that way, kind of thing, right? But I'm also going to trade on a smaller time frame, and I'm going to trade for various other reasons. But the most important thing is I thought about it. And then the next important thing is I carry out actions that will implement my strategy. And I want to do it as low risk as possible. Cool. So thinking about it first, developing a strategy second, third, actually implementing the strategy, and four, removing the risk. Okay? So I hope it was helpful today. CPI, crazy. The price is basically right back to where it was before. How nice is that? No, that they don't have a time yet. They generally release, but I would say 1:30 a.m. New York. Okay. So again, guys, I want you to succeed, and sometimes it's important to have a wake-up call. And I'm looking at this week and next week as being absolutely, totally, potentially, absolutely, totally critical. And if I don't tell you this, and even maybe like slap you across the face to make sure you're paying attention, because hey, if you ever have kids, you know, half the time you have to say, hey, look at me, look at me, look at me, I'm talking to you, right? Yeah. Hello, can you hear my words, right? And then when you got their attention, make sure the message gets across. This week and next week are unusually important, and I want you to be aware. So this is the time when summer's over, guys. Put your swim trunks away. Call all your friends and tell them to disappear until, you know, New Year's Eve. I'm busy. Don't call me, huh? You're my best friend. Don't call me until Christmas Eve or until New Year's Eve. I'm busy. These are the best currency trading months of the year. I'm gonna be all in. I'm gonna be busy 20 hours a day, so don't call me. Be my best friend. Don't distract me. And just focus, right? So the dragon has awakened. What are you going to do about it? Well, it'd be helpful to be even aware there's a dragon. Hey, what's that giant dragon in the room? What dragon? I didn't even know there was a dragon. Right, so cool. This is going to be awesome, guys. The next 100 days are going to be awesome. Or you're going to miss the whole thing, and you're going to say, wow, I totally missed out on that 1,000 pip move. It just felt like nothing happened. The market was slow, and everybody told me you can't money in the summer because the market's low. There's no volume. There's no volatility. You just can't do it. And then, oh, it moved 1,000 pips without me. Well, I know that happens all the time. I've been doing this for over 10 years, guys. I know it happens all the time, and I don't want you to miss it. I want you to be ready and focused. So plan out your charts. Think about what's going to happen over the next 100 days technically. Don't worry about the fundamental part. Just do it technically. What direction is the market likely to go over the next 100 days? Come on, you should be able to do that. And then if it's not going to go straight down or straight up, where are the pullbacks going to be? You should be able to figure that out now. I'm not joking. And let's crush it together, huh? Thank you for being on my team. Every single day at forex.today, the videos are posted on the homepage. Here's yesterday's session. Technicals, fundies, taxes, trading PC. I think we even talked about MACD in there. All the videos are also posted here. And what is it? It's the 19th. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There's 11 posts today already showing trading ideas for the foreign exchange market. I suppose that's why they call it Forex Today. 11 trading ideas. I hope you go through and read them and see if you agree, see if you disagree. So peace on earth. May the pips be with you. May your profits be above average. Open a live account at TradersWay.com and tell them that I sent you. And this is me toasting you with a glass of champagne to your big success that's about to begin. We'll take this journey together. Cheers.